Well, good morning, everyone. It's great to come after Roy, and it is kind of funny. So next month will mark 28 years that I've been doing research on the ETF industry, and I do remember Roy calling me back probably before 2008 saying, really excited that ETFs are going to be listed in Israel and people can even trade on the weekend. I'm going to give you some overview of the ETF industry in general, but then focus on why being able as retail investors and even institutions and financial advisors, being able to use ETFs is really something quite special because they're really the only democratic investment product that's out there where you find that, and I'm going to tell you about central banks, about governments, about sovereign wealth funds, about pension funds, using ETFs to do many different things. And that is increasing a lot. And you, as individual investors or advisors or institutions, have the ability to use these same products. And as Roy was saying, you do see a lot of home country bias. You do see over the past few years how many investors have been using ETFs for exposure to the S&P 500 because you can waste a lot of time trying to do better than the index and underperform. And today, globally, we have 85 ETFs tracking the S&P 500 with $2.5 trillion invested. So what is an ETF? Just real basic stuff, and I know this has probably been said earlier, but I think it's really important to remember an ETF, wherever it's domiciled, is regulated like a fund, but it has the added benefits of being listed and traded on an exchange somewhere in the world, sometimes cross-listed. So it's not an asset class, because often people say, oh, it's an asset class. And inside of it, you can have active ETFs in many geographies, although what we have seen is, from the beginning, many regulators thought ETFs meant index. And so in some places, regulations have had to change to allow for active ETFs to come to market, like in Japan recently. In other places, the regulators and the tax authorities have given index ETFs tax benefits, and they don't want active ETFs to come to the market to compete with active mutual funds. So there are some impediments. This year marked the 35th anniversary of the listing of the first ETF. Most people rarely give Canada credit for that, but it was in Canada on March 9th. This year is the 101st anniversary of the listing of, or creation of, the first mutual fund. So ETFs are much younger than mutual funds. And this month marked the 25th anniversary of the first ETFs in Europe. So they were on the Deutsche Börse on April 11th. 2 weeks later, the first one came to the London Stock Exchange. And if we look at where we are at the end of Q1, we see that the ETF industry today is just over $15 trillion at the end of Q1. We have taken in a record amount of $463 billion of net inflows. So that's creations versus redemptions. But more importantly, we've had 70 months of consecutive net inflows. So people have, regardless of what's happened over the past 5 years, continued to put net new money into ETFs. So it's not just flows looking at trading every day, it's when did someone go and buy the underlying securities, and the ETFs get bigger. So we're not just looking at market moves. And when we look at the landscape of ETFs, because I do think that is important, the US, although it wasn't first, accounts for 69% of all the assets. Europe is now at 16%. And then you can see Asia and Japan are smaller. Canada, which was first, is only about 3%. The products, if you look at the types of ETFs, equity ETFs still account for about 71% of all the assets. Fixed income didn't come to market until 10 years after the first equity ETFs, and they're now at 15%. And active ETFs really came about in 2008, and they weren't really embraced. So the first active ETF in the US was listed by Bear Stearns. Not sure how many of you remember Bear Stearns. And the ticker was YYY. And many people were, why do we need active ETFs? They really felt they were for index exposure. And we've seen now that active ETF is really growing significantly because advisors and retail investors and institutions like the fact that they can use the same wrapper to trade whenever they want to. So the things that Roy was saying about liquidity, ease of access, is very important to many investors, as well as transparency. So you know what are you investing in. If you're investing in a theme or ESG, you can check what's inside of it to feel comfortable. And here, if we look at the types of ETFs, so market cap, as I said, things like the S&P 500 are still very popular as building blocks. So although they are index, people actively use ETFs to generate alpha through asset allocation. And I think that's really important to remember. It's not that people who use ETFs are passive and doing nothing, but rather using this as an investment strategy. Smart beta, so the themes have become, again, more popular. The most popular strategy is investing in yield, so income. So if you look at during COVID, many companies stopped paying out dividends, and so the smart beta strategies became less popular. If you go down a bit, during COVID, thematic ETFs were very popular, primarily, I believe, because many people were sitting at home watching the TV, and if you watch CNBC, you know, they're basically a marketing machine for ETFs. They'll say, okay, these sectors are going up, or these themes are working, and here's tickers. And so for a lot of men, they started to invest in themes because they were kind of exciting. You can buy a pet ETF, work from home ETF, airlines if you felt they were going to go up or down. Now you're seeing that themes are less important or less used by investors in developed markets, but they're actually still very popular in Asian markets. And then you can see currency hedge and ESG and crypto. So if we look at where has the money gone in Q1 this year, most of it has gone into equities, so over $211 billion. Active ETFs have taken in 145. So active is a subset broken out of the total 15 trillion. When I say equity, fixed income, or commodities, those are all index exposures. So gold has come back for many investors, so we're seeing money going into commodities. And so down on the bottom there, you can see that the net inflows are 463 billion year-to-date Q1. Last year at this time, we were only at 397. In all of last year, they took in 1.8 trillion US dollars. So this shows you the growth of the ETF industry. We've seen that in general, every 5 years, the assets are doubling. I expect that to continue, and if we were to look only at Europe, we are currently sitting at 2.4, and I expect that we'll get to 5 trillion US dollars by the end of 2030. So we are seeing robust growth in Europe, driven by retail use, advisors, but also the institutions. And so I was asked to talk about the use by central banks and pension funds and institutional investors. So many people wouldn't think that central banks would be investing in ETFs at all because they're basically sitting there talking about interest rates, but they all have reserves. And the official Monetary and Financial Institution Forum does a survey every year where they ask central banks, are they using ETFs? They surveyed last year 171 central banks, 73 responded. They have reserves of $5.4 trillion. And you found that 28 of them are using ETFs, and they're using them to provide diversification for their reserves. They like them for sustainable integration. They also like the fact that they're liquid and tradable. They don't require them to open special mandates. And so you are seeing that, if we look on the next slide, there are many of them that are expecting to use ETFs more. So 23 of these funds expect to use ETFs more in the future. A lot of them are using them now to get exposure to equities, but they're also using them to get exposure to bonds, corporate bonds, investment grade, I should say, and high yield. And what I thought I would do is talk a little bit about some of the uses that we've seen. So it was big news during COVID when the Fed, for the first time, actually bought investment grade and high yield bonds. If you remember back to that time, many of the regulators, IOSCO and others, were concerned, and that's the global regulator, said that they felt that ETFs for fixed income would not work if there was ever a financial crisis. What we actually found was ETFs worked better than mutual funds, because the way they work is you actually speak to authorized participants or market makers, and they figure out what is the real current price that you could buy or sell bonds at. And what you found with mutual funds, the pricing was very stale. So ETFs actually became price discovery vehicles. We found that many pension funds actually transitioned portfolios they were running in-house into ETFs. And the Fed in 2020 started to buy investment grade and high yield bonds. They bought 1.3 billion at one point. They were buying ETFs from iShares BlackRock, Vanguard, and State Street. So not a broad set of ETFs. They wanted them to be sizable in terms of the existing assets in them. But I do think that it surprised many, but I do think it also gave confidence to many investors that fixed income ETFs worked and they could continue to use them. So I think it was an important statement when they were buying them. Another central bank that's been using ETFs for a very long time is the Bank of Japan. So the Bank of Japan has been using ETFs, equity ones that is, for quantitative easing or monetary policy since 2012. And they basically are using them from all of the local ETF issuers. So you have Daiwa, Nikko, and Nomura. So they're using TOPIX and Nikkei 225 ETFs. And if you look at their use of ETFs, it's been very significant. They currently account for 42% of all of the ETF assets locally domiciled in Japan, although they did say in March of 2024 that they would no longer be buying more ETFs. I think now the question is, what do they do? I actually think what they should do is use the ETFs they have today to do a request for proposal to create a new ETF so that they're not picking one of the top three firms in Japan and annoying the other two, and create a new product that would be like the tracker fund I'm going to talk about, where it would be something that would be encouraged for the retail investors to invest in their NISA, which is a long-term savings product, where they're trying to get retail investors to invest as opposed to putting money in savings. So just like Roy said, you see around the world that many governments are wanting retail investors to be investing and not just putting money into savings accounts. We have the same issue in the UK, which is where I live. We have the same issue across Europe. And so I think part of it is people expect the governments to take care of them, but the reality is the pension funds are underfunded or will be underfunded. So if you want to stay at the same quality of life as you retire, you do need to be saving. So if we move on to Europe, what we are seeing is that European central banks are also increasingly using ETFs. And I think they illustrate some interesting things that they're doing. I'm going to talk about a few examples, but to summarize quickly, Bank of Finland is using them to get exposure to ESG and also thematic climate-focused ETFs. The National Bank of Austria is using equity and corporate bond ETFs, but they've also added ETFs to their securities lending program. And securities lending is actually something that is unique about ETFs compared to mutual funds in that if you own ETFs, you can lend them out, you earn lending revenue lending them, and the person who borrows them can earn revenue if they're able to sell them when they borrow them, buy them back at a cheaper price, and then they earn money. So securities lending is something that isn't always discussed, but is an added revenue stream for institutional investors. And then Bank of Latvia is buying emerging market debt and equity ETFs, and Slovakia is buying equity and corporate bonds. So I thought I'd just dive in a little bit about, am I up? Okay. So if we look at this, you can just see how they're able to use ETFs to really fulfill their roadmap to going carbon neutral. I do think I started a little bit late, but I'll move on to the next one in effort of saving time. So this is an example of a sovereign wealth fund. The Public Investment Fund in Saudi Arabia, it has $930 billion of assets, and their goal is to support government initiatives. Saudi Arabia has a vision 2030 where what they're looking to do is to encourage investors from outside of Saudi Arabia to embrace the idea that Saudi Arabia is more than just oil. And so they're trying to move to tourism and other things. What they have done in the past couple years is they have created, in partnership, some of the largest ETFs. So back in with CSOP in Hong Kong, they created a Saudi ETF that listed with a size of $1 billion US, was the largest IPO in 2023 in the Hong Kong Stock Exchange. And it also has feeder funds into China. So Hong Kong goes to Shanghai and Shenzhen. They also created an ETF that's available in Tokyo. And more recently, they created a fixed income ETF that's available with State Street, that's listed on the Deutsche Börse, London Stock Exchange, and on Euronext. I think the other initiative, which I'll go through just really quickly, is the World Bank has been partnering with ministries of finance and treasury departments to create ETFs. The first one they created was in Brazil, came about in 2019. They more recently have created a second one that was launched last year in Colombia, where they worked with the Ministry of Finance, and then Global X launched that one, dominated in pesos. They're working on a new one in Brazil, which is looking at creating an equity ESG product. And I told you I would mention the Tracker Fund of Hong Kong. So the Tracker Fund of Hong Kong was a very interesting product when it came to market. We had the Asian crisis back in 1998. The government was buying local equities to support the market. And then the question was, what do we do with all these securities? So they did a request for proposal. They ended up creating the Tracker Fund, which today has still $16.3 billion. It is the biggest ETF out in Asia still, and it was created with features that made it very attractive for retail. It pays out dividends, and so you saw the uptake in investment by retail investors in Hong Kong to be very significant. And maybe I'll just share that what we've also seen is, in addition to kind of the governments using ETFs, in Mexico and Chile, they've been encouraged as pension funds to invest in ETFs. So you see the use of ETFs from the US and Europe being very significant for foreign exposure. So like Roy was saying, often people feel they're able to invest domestically. When they look to invest outside of their home country, the regulators have encouraged the pension funds to look at ETFs. And this just gives you a sense of some of the pension funds that are using ETFs for equity, for fixed income, for commodities. And we've seen some of the largest launches of ESG products in the US being seeded by pension funds from Asia, the US, and from Europe. So over $1 billion in listing sizes when some of these products have come to market. So I think, in short, what we see is ETFs have provided a solution to allow pension funds, but also you, to equitize cash as core holdings, as satellites, for sector rotation, for transitions, in model portfolios. And so my view is that the use of ETFs and where they're available and how and who's using them is going to continue to grow. And that's why I feel that if we look just at Europe, the assets will be at $5 billion by the end of 2030, up from where we are today at 2.4 billion US. So thank you for having me, and I hope you found that interesting. Thank you. Thank you.